This week is not going to be a normal trading week. And matter of fact, we haven't had a normal trading week in a very long time. But this week, three of the world's most powerful central banks are going to be making their rate decisions inside a 4-day window period, starting off tomorrow in Asian session, which is going to be Bank of Japan Monday night. Then we have the Federal Reserve on Wednesday afternoon. And then Thursday in the morning, we have Bank of England. And hanging over every single trade in every single market this week is still going to be the main question that could change the global inflation picture overnight. And that is, does the US and Iran peace deal get signed? And does the Strait of Hormuz reopen? So this week, you're going to feel like there's a lot of volatility, a lot of reactionary moves that are happening in the market, and that sentiment is pretty much correct. The institutional edge here this week does not go to the trader who does the most, but it goes to the trader who does the least until they have confirmation. So let's go over the full macro picture, the fundamentals, the market sentiment data points, and the technical analysis, the type of scenarios, and exactly when I would personally be considering putting a trade on. So let's get into it. Starting off with first the macro regime, let's go back to last week and start off with the CPI data points first and get a picture of the overall inflation and what's going on there. So we had the most recent US CPI report that was released on Wednesday, June 10th, and that came out year over year at 4.2%. And that's the highest reading since April 2023, which is also the third consecutive monthly acceleration that we have seen when it comes to inflation. That number itself that we have seen here with 0.5 and 4.2%, they were in line with expectations. But inside of this, exactly what's going on is exactly what matters a lot more, which has been missed by a lot of retail traders very specifically. The main data point here that's skewing the entire inflation here is mainly energy prices. Energy prices are up about 23.5% year over year. Gasoline alone is up about 40.5%. Fuel oil is about 58.9%. And energy accounted for more than 60% of the entire monthly increase in CPI. You get that confirmation when you're looking at the core CPI data points. So this is excluding food and energy. And right now, we know that CPI is increasing for all major economies because of the Strait of Hormuz. Now, the important thing to understand when it comes to inflation is that, again, you strip out food and energy, core CPI, and you get 2.9% on that year over year. Monthly sitting at 0.2%, which was just below the 0.3% acceleration that we were seeing. So the inflation problem right now is overwhelmingly just supply driven. It's Strait of Hormuz story, and it's not because of demand overheating or anything. You also see that due to this, we're seeing real wages are being squeezed. Average hourly earnings grew about 3.4% year over year against a 4.2% inflation, which means that the average American worker has now lost their purchasing power as of May. And that is 2 consecutive months of negative real wage growth that we're looking at. So the Fed really cannot fix that with just simply interest rates, because interest rates are not going to reopen a shipping lane. Another thing that we want to watch out for going into interest rates this week is going to be the labor market. So all of the first week of June, you had employment data coming out. Let's continue out with JOLTS job openings. So when that came out that week, we also, during the live session, we talked about it on Wednesday, that majority of the jobs that are opening up are mainly due to the AI demand that we're getting. So any jobs related to AI, that's where you're seeing a lot of the jobs opening up, not so much on any of the other sectors. Then on Wednesday, you had, let's continue down here, we had ADP non-farm employment change come out as well, which was, a nice increase compared to the previous. What I'm interested in is NFP and what is happening with unemployment rate here. So the May jobs report, which was released on June 5th, on Friday, NFP, showed that 172,000 non-farm payrolls were added, which is more than double the consensus estimate of approximately 85,000 that we see here. That's a huge cushion compared to the previous. So the market was pretty much preparing that we're going to see less jobs opening up. But again, the main skewing point here is because of those AI-related or tech-related jobs that we're seeing. Unemployment held at 4.3%. And March and April were revised up by a combination of about 93,000. So on the surface level, it looks like, a strong labor market, but here's what the institutional read is here, and the gap when it comes to the retail side of understanding and putting the bigger picture together is that the bulk of the gains were in leisure, hospitality, and AI side. 70,000 jobs, nearly 5 times the 12-month average, were driven in part by the FIFA World Cup arriving in the US this month. Local government added about 55,000 jobs. Financial activities lost 22,000. So the headline will cover or mask a low hire and low fire market where the long-term unemployed share is currently rising. 27.5% of unemployed workers have been out of work for 27 weeks or more. And the job number was strong enough to basically keep the Fed on hold, but it's not strong enough to tell them to cut, right? And it was just as ambiguous enough to keep the hawkish dissent alive inside the committee right now. Another thing that you should be watching out for on a weekly basis is the unemployment claims. So you see that massive push up. So that's what I'm talking about of the unemployed workers that have been out of work for about 27 weeks or more. Then you look at the overall global picture, especially when it comes to the US and Iran war. The Strait of Hormuz has been effectively closed since March 2nd, 2026, when Iran confirmed the control of the waterway. That single event has been the primary driver of the 2026 inflation surge, the energy shock, and the fracturing central bank coordination globally. And on Saturday, President Trump announced via his social media that a peace deal would be signed on Sunday, June 14th, essentially today, and that Strait of Hormuz would reopen immediately after. But then we see that Iran side pushed back on that. We haven't had any sort of signing that has been confirmed yet, and instead, we're seeing that the U.S. military shot down Iranian drones targeting the commercial ships near the strait as recently as yesterday on Saturday. So this deal is very close, but it's not done, and that is the distinction that's going to matter for majority of our trades this entire week. Iran already said today that they're not going to get any sort of deal on Sunday. They're not going to be signing any sort of deal just yet. So when you're looking at the overall macro picture, we're trading in a supply shock stagflationary environment where the standard policy tools like interest rate changes are going to have very limited effectiveness against the underlying cause. The central banks are basically being asked to fight off inflation or energy-driven inflation with demand-side instruments. And that structural reality is the backdrop for everything that's going to be happening this week. Now, looking at very specifically Bank of Japan, since that's the first interest rates that we're going to be getting today or this week, we have that tomorrow in Asian session. Right now, Bank of Japan policy rate, we're seeing that it's sitting at 0.75%. We're expecting an increase of 25 basis points. The market is going into this decision, and it's already pricing in approximately a 98% probability of that 25 basis point hike to that full 1%. Now, what I want you guys to do is sit with that number, 98%. That is when the market is that certain about a central bank outcome, and what you are actually trading is not going to be the real decision. It's everything else that's around it. I've done a video on YouTube about USDJPY very recently. I highly recommend that you guys go back and watch that because I completely break down how the carry trade there and how the Japanese finance authorities' intervention to the yen is really going to be impacting all the other assets that we're looking at. So even if you're trading futures, currencies, commodities, whatever, crypto, you need to be watching out for what's happening here because you're going to see an effect in all those assets as well. So the main context here around the interest rates here is that the April 28th Bank of Japan vote was 6-3 to hold. That was the most divided the board had been in years. Multiple board members were explicitly saying in April meeting summary that a hike was quite possible even if the future course of the Middle East remains unclear. And very specifically, since we look at Bloomberg, the Bloomberg article also reported that the Bank of Japan is mulling the June hike. Bank of America and Reuters polls of economists are 94% in favor of that. Bank of Japan's governor has been building this expectation very intentionally and deliberately. So why would the market still react if, we're sitting at 98% probability? Because even at 98% probability, a hike is basically, fully priced in. If they hike and the guidance is cautious, if Bank of Japan's governor says that, quote unquote, we will be patient from here, then the yen could actually weaken on the news because the market expected more aggressive forward guidance. On the other hand, if they hike and signal another move by October, then the yen is going to spike, and that carry trade that I talk about in that USDJPY video is going to unwind hard. If they hold, which is about a 2% probability outcome here, every JPY cross pair is going to make a very violent move in the opposite direction. So you do not want to hold onto any JPY cross positions through this decision here. Another thing that I want to pull up here is going to be the Commitment of Traders report, Forex.com, or you can just go directly to Commitment of Traders website and look it up there as well. But in this article here, basically we're seeing short bets against the Japanese yen hit a record high among large speculators as of June 7th COT report. The data here is reflecting Tuesday, June 3rd positioning, which is about a 3-day business lag. So a record speculative short position in the yen going into a near certain hike is your textbook style crowded short setup. That the institutional trade is not to join the crowd here, is to rather wait for the reaction and then look for the squeeze, and that's how you're going to be looking at your potential trades. So as you continue down to this article, you'll see the asset manager positioning as well, especially for the yen, and as you continue further down, you get USD JPY as well. So I would highly recommend go back and read this. It's on Forex.com again. After that, we have the Federal Reserve decision. So the Federal Reserve is going to meet June 16th to 17th. The decision is going to drop on June 17th and in the afternoon, followed by Kevin Warsh's press conference. This is his first press conference. And so the market is pretty uncertain about what to expect here. The rate itself is near certainty a hold as of right now. And we're seeing about 98 to 99.5% probability of no change. So once again, the rate or the decision here is not going to be the trade. What we're actually watching is first the dot plot. The dot plot summary is, or the dot plot is the summary of economic projections that show where each FOMC member thinks that the rate should be at the end of 2026, 2027, and beyond. In March, the median dot projected one cut in 2026. Since then, CPI has accelerated to 4.2%. Jobs came in at about 172,000, doubled expectations. And if the June dot plot removes that projected cut entirely, if the median moves from one cut to zero cuts or from zero cuts to one hike, that is a hawkish shock. So the 2-year treasury yields will reprice, the dollar will move, the gold will move, NASDAQ will move, all of that happens before Warsh says a single word during the press conference. Now that's the second thing that we're going to be watching out for, his press conference. This is his first as the Fed chair. And, he was also confirmed with 54 to 45, the most divided confirmation that we have seen in the Fed history as well. And he was sworn in last month in May. He has publicly already signaled that he wants to run a leaner Fed that communicates less and relies less on forward guidance. And if he follows through on that, then this press conference will be a lot shorter, crisper, less predictable, basically, than anything that we have seen under Powell. So the markets really don't know what to expect from him yet. And that uncertainty itself is also a volatility premium going on to Wednesday. So you can see how we have a lot of different layers already going into Wednesday for this entire week. So we're just waiting to see if there's going to be any sort of hawkish signal. And, if we see a language shift here, if they remove completely any sort of rate cut language, then we're going to see that enough is going to be just a hawkish signal without even a rate move here. So you're not trading the announcement. You're going to wait for the candle close after the press conference ends. And any wick rejections, all that stuff is just going to be noise. You want to see actual candle closures because that's going to be your decision point. Then going into Thursday, we have Bank of England's interest rates coming out. The current rate is sitting at about 3.75%. It was held there at the April meeting with about an 8-1 vote, with the chief economist, Pill, as the lone dissenter, voting to raise rates to about 4%. That hawkish dissent was the first vote for a rate increase since the tightening cycle ended back in summer of 2023. The bank's own projections show CPI rising to about 3.1% in quarter 2, 3.3% in quarter 3, and higher in quarter 4 before the easing. The hold here is the base case for at least this month. Governor Bailey has stated that they are quote unquote in no rush, but here's what makes this meeting live. UK CPI for May released the day about 2 days before. So on Tuesday in pre-London session, you're going to have CPI data coming out. And the reading for that is sitting at about previous 2.8%. We're expecting an increase up to 3%. And if it comes above 3%, Then the MPC walks into Thursday's meeting with fresh evidence that inflation is reaccelerating. If a second member joins Pill in voting for a hike, that is a bullish GBP shock that the market is fully not pricing in just yet. The vote count on Thursday is going to tell us everything. If we get another 8-1, then you have a hold, that's confirmed, minor GBP reaction. If you get a 7-2 hike vote, GBP is going to spike. If you get 8-1 in the opposite direction towards a cut, which is almost impossible in this environment, but it would be, a huge spike or collapse for the pound. So that was all from the macro perspective, but we need to understand, how does the data position here in terms of market sentiment? So all of the commitment of traders report that we're looking at, again, that is delayed, but we just looked at the Japanese yen one from Forex.com. You have another one from gold. So for gold report, we see that the CFTC speculative net long positions in gold previously were sitting at 176,000. That was up from the 154,300 from the prior week. The net speculative longs rising to 176,000 contracts is elevated positioning read here. So the institutional signal here is it's not bullish, it's just a pre-run flag. But as of yesterday, we got an actual of about 173.8K, which has dropped just a little bit compared to the previous, but it doesn't change the overall trend that we're looking at, significantly. This is a lot of positioning right before major interest rates are coming out. So once again, the deal optimism here is going to add to that downside pressure. And the institutional data is not supporting a fresh long in gold just this week. But if we see any sort of deal pessimism or not a deal not happening, more attacks, then that's going to add, a lot more bid to the US dollar as well. So we have that. We also, let's go ahead and take a look at Forex factor here again, if there's any other data points. We have retail sales coming out on Wednesday as well from the US, and then President Trump, who will be talking at the G7 meetings. So we also have G7 meetings that are going to be happening this week. So we have a lot from a fundamental perspective happening this week that we need to watch out for. Now let's come over to the technical side, and then we'll go over all the different scenarios that we're trading. So this last week we had a top wick rejection, I would just say 51,500. And here we had a massive bottom wick rejection. So if you want, you can map that out. What I'm going to do is map out first the candle closures. And then if price can break below that, then we can look for those continued sells to a downside coming into that wick fill to about 49,750. So almost 1,000 point move to the downside. The reason why I'm mapping this out is because on the daily time frame, now you start to see consolidation here. So if I'm looking for, let's say, swing trade opportunities, and if this was any other pair, I would just stay out of it until price can break above 51,500 or break below 50,700. But because this is US 30, there's a lot of volatility. You can absolutely look for some scalp opportunities here as well. What I'm going to do is drop down to the 4-hour time frame. And on the 4-hour time frame, I can see that price is currently sitting at a minor resistance, which is right around here. So if price continues pushing back up bullish, you have about a range for 260 points to the upside that you can still catch. If price just rejects this and then pushes back down bearish, I would narrow into my no trade zone, which would be right around here, which is at previous resistance. I see a little bit of break and retest. Price failed to continue bullish, so it came back down. And we have a lot of wick rejections right into this area here as well. So if I'm looking for any sells, we're going to look for a continuation down for about 214 points, or all the way down for about 340 or 330 points to a downside, coming to 50,700. You can drop down to the 1-hour time frame and you see consolidation here. So that should give you clear clues of why you should be staying out of the zone, right? There's not much happening in the zone. It seems like more like a liquidity zone before price finds its direction in either way. Then we go over to NAS 100, go over to the weekly time frame. Pretty similar setup as US 30 with a nice bottom wick rejection here. So we're going to do candle body once again, and I will do 28,800. We have the top wick rejection, 29,800. Drop down to the daily time frame. So on the daily time frame, I can see that we're tapping right into that same exact resistance as we have tapped into previously. So now we're going to drop down to the 4-hour time frame, and I see consolidation here once again. So I will not mark out a resistance here just because we're so close to the 29,800, but what I will do is mark out a support area and say that if price drops below this, then you can look for a very quick scalp opportunity to the downside, coming for about 200 points to the downside, and then a continuation down further if price breaks below that for about 700 points. Drop down to the 1-hour time frame. So first target coming down here, and then second target down here if it continues pushing back down bearish. As of right now, we do have a bit of a bearish structure when it comes to the intraday time frames, kind of tapping into the equal highs here. So we don't have a confirmation of a full-blown sell opportunity that's happening here, and we also don't have a confirmation of price just continue to push back up bullish. NASDAQ, I was expecting that it would come back and close into 30,000 last week, given SpaceX IPO, which now is part of NASDAQ. But even with that, we didn't see a huge push. So the market's pretty much waiting to see what happens as the market opens up this week. So we're going to be very careful. Same thing with NASDAQ. We're not going to leave any open positions overnight. You're looking for scalps, potential day trades, but making sure that you're staying out of these consolidation areas here. So this is no trade. This is a quick sell opportunity. Couple of scenarios that you should be preparing for is you wait for a candle closure below this area. You look for sells coming all the way down here. And let's say price simply wants to tap into this consolidation and bounce back up. You still have nice sells, and then you can cash those buys to the upside again. But let's say price continues pushing back down. You've already caught a sell from up top here. You take partials, you trail your stop loss, you look for another break and retest, and a continuation down. Now you have another scaling opportunity with a running profitable trade from up top there. Coming over to USD or GBP USD. Now for this, you have Bank of England interest rates, and you have USD interest rates, and you have US and Iran headlines that you're watching out for. Right now, we are sitting at a weekly support at 1.33. And then you also have your resistance up top here. So when I see this, I know that when I drop down to lower time frames, I don't have any swing trade opportunities. If anything, I would look for potential scalps. But like I have said for the last couple of weekly outlooks for GBP USD and Euro USD, given that they're both sitting in consolidation, they're also sitting at monthly potential resistance or support levels depending on the pair. It's just best to wait for price to break out of these weekly consolidation areas and then look for your swing trades. So I'm reserving these two pairs specifically for swing trading, not even for day trading or scalping. But let's say if you were day trading this, then you drop down to the 4-hour time frame and you see your consolidation that's forming here as well. Price breaks out of that. You have a range that you can trade for about 40 pips to the upside, or price breaks below this 4-hour consolidation support, and then you have sell opportunities that you can catch to the downside for about 60 pips. Nothing in between. Don't trade these major pairs when they're sitting in consolidation. You will just get stuck in consolidation and there's no point. Same thing with your USD sitting at a major support, even on a monthly time frame. So you're going to drop down to the weekly, narrow in your level. So this is our weekly support. 1.5. And then top with projection from last week. Just say 1.6. Drop down to the daily, and on the daily time frame, same thing. You have this entire range for about not even 100 pips. So that alone would tell me that I'm not looking for trades unless price can break either above the resistance or below the support. For swing trades, I would reserve it. But if you were day trading this, then you've got your 4-hour support and your 4-hour resistance. Now you wait for price to break out of that. If you end up looking for buys above the zone, you have about 20 pips, which I still think is a very tight range given that we have a lot of other pairs with great opportunity, or sells for about 62. Continue down to PJPY. Just remember, for all yen crosses, you still have the Japanese finance authorities stepping in and interfering into the currency market. That is still a very much live risk at the moment. So you have your 215.3 and your bottom wick rejection from last week at 213. drop down to the daily. And you're starting to see that price is starting to push back up a little bit bullish. A little bit messier price action, you know, with candles just closing like dojis, breaking highs and lows, looking more like liquidity setups, textbook style liquidity setups. So you come down to the 4-hour time frame, and this is where I would create my zone, which is my support. And then if you were scalping this, you would just create a resistance up top here. I personally would not keep that resistance, just given that it's a very small range to the upside. We're about 30 pips. So I would just leave it. But for sells, you have continuation down for about 65 pips. And then whatever ends up happening with Bank of Japan, that's really going to be the main catalyst here to help push this pair. You have about 155 pips to the downside that you can still catch here. USD/JPY, I am still staying out of it, but you can still continue to watch what is happening here. We are currently sitting right above 160. And we also have just a support area right down here. Last weekly candle closed like a doji here. So 159.3. Drop down to the daily time frame. You're going to map out your support right around here. And if the bearish volume from Thursday continues, then we look for ourselves to a downside. If you're scalping this or day trading it, we're about 60 pips to the downside, depending on your entry. I'm staying out of any sort of buys here for USD/JPY at the moment. Then come over to Euro/JPY. We haven't analyzed this pair in a very long time, but I know there are some people who are trading this. So we have our weekly resistance, 185.7, and our support. You can already see, as we just narrowed in, that this is also another weekly consolidation. So in terms of swing trades, there's nothing happening here. Now we come down to the 4-hour time frame. Narrow in your zones if you're looking for scalps. If you're looking for price to break below that, continue pushing down. You have a trade for about 50 pips and the hold sell for about 125 pips. You have your 4-hour consolidation resistance right up top here, and your scalp buys for about 21 pips to the upside. So notice how majority of these pairs are just sitting in consolidation, right? That's pre-positioning that's happening right ahead of these macro fundamentals. Now coming over to gold, we have created a new lower low formation as of this past week. And we have our top rejection right up top here. I'm going to map that out, and it also checks out with the previous rejections that we have to the left. 4367.8. Drop down to the daily. So on the daily time frame, we have this resistance right here. So if you look to the left, it's that consolidation support, resistance, resistance before a pullback, and then a continuation back up, and a resistance hold here. Drop down to the 4-hour time frame. That also checks out as a 4-hour consolidation resistance. I'm going to narrow in my support if I'm looking for any sell opportunities. My sells are going to be either below this area here, or my buys are going to be above the 4-hour consolidation resistance. If I drop down to the 1-hour time frame, I continue to see that it's all just consolidation. So you want to wait for candle closures here and then look for your entry points. Let's continue down. Expect volatility, because yesterday Trump literally said that they were going to get a deal today. Iran said, yeah, we're not getting that. And then we also have a lot of pre-positioning that's happening going into the interest rates week. Now we come over to silver. Same exact thing, where you have a massive bottom with rejection, but the good thing here is that we have not broken the previous lows. Then we also have top with rejection from last week. Did end up closing bullish. Drop down to the daily. So daily is currently rejecting right into a previous support area before a continuation back up bullish. So here what I'm going to do is right off the bat, I can already narrow in my levels. But let's say if you didn't see this, then you drop down to the 4-hour time frame and you see a 4-hour support here. Anything in between, I will not be trading that. If price breaks above 69.1, I will be looking for those clean buys to come back up bullish into about 71.24 or a continuation up into 72 flat. For sell opportunities, I want candle closures below the support and then a push back down. First targeting closer to 65 and then coming closer to 63.5 and then 61.6. Let's take a look at oil now. So oil had a nice little dump. $83 is what Goldman Sachs analyst we're watching out for, which we have already tapped into. And that would have happened if there was a lot of optimism around the Strait of Hormuz opening up. And then we have our topic projection on 95.6. We're going to keep it at that, but I'm expecting the market to gap whenever it opens up here in a couple of hours. Right now, even on the daily time frame, you're holding on to a nice support. If price gaps below that, that's going to be mainly off of optimism of Strait of Hormuz opening up, which I don't think is going to happen, given that Iran has already just said that we're not signing any sort of deal this weekend. It's going to take a couple of days. They're still talking through it. So given that type of sentiment, I am expecting the market to gap up. So for that reason, what I'm going to do is map out my support area right here and the market gapping up above the 88 mark and take it right into 95.6. Come over to the 4-hour time frame. Same exact thing. It checks out as a major level. So these are the key scenarios that we will be trading this week. Central bank weeks are the weeks that are going to blow accounts. And it's not because the moves are massive. It's because a lot of traders jump in on the first move and then they end up getting stopped out by the reversal before the actual trend starts. So my rules for this week, and they're not going to change regardless of how the market moves, are maximum 2 trades per day. So that's not a guideline. That's my hard cap on a week with 3 central bank decisions. The temptation is to be in the market constantly, but that's the complete opposite of what you should be doing of what is going to save your account. I'm also looking for a minimum of about 3-to-1 risk to reward on every trade. If the setup is not offering me about 3-to-1, I'm not taking it. And that comes from just a risk management perspective, where a 1-to-1 is going to look like a very easy trade, but in a 1-to-1 is where you end up getting stuck in those massive wick rejections, the massive liquidity grabs that you end up seeing. So rather, I'm going to go for a much cleaner setup, which is going to give me a minimum of 3-to-1 risk to reward. So there will be setups this week that look like, 2-to-1 plays after the announcement, or 1-to-1. I'm passing on those. My risk is about 1 to 3% per trade. Usually that's all I trade, closer to about 2%, but this week I'm going to be at the lower end of that range, closer to 1 to 2%. No positions through the announcements without a confirmed close after the actual interest rates have come out. Bank of Japan announces Monday night, so no JPY positions through the overnight. FOMC announces Wednesday, so no positions that morning until after the interest rates have been released. We are going to have our Wednesday live session instead of at the New York Open, at the actual interest rate release about 30 minutes before that. I already have that under my live tab on YouTube. So you can just hit notify. So then you get notified as soon as we start. And then we're going to wait for Warsh's press conference to end. Then we're going to look for, any sort of potential trades that might be setting up there. That candle is going to be the setup that we're going to be trading around the interest rates, nothing before that. On the Iran deal, we're not trading any sort of rumor. The deal has been, quote unquote, very close multiple times since March. If it gets signed and confirmed, the Strait of Hormuz is confirmed to be open, and that's going to be the massive trade setup that we're preparing for, especially with US oil and equities. So a Trump social media post is not going to be a trade setup. You're going to expect volatility there. But the best thing is, or the best trade this week is going to be not taking any sort of trades at least 30 minutes before interest rates are supposed to be released. So again, I will be live on YouTube on Wednesday at 10:30 a.m. PST, 30 minutes before the FOMC decision and throughout Warsh's press conference. So make sure that you guys tune in for that. That is where this week's setups will confirm or fail. So, come find out with me. And if you want the full framework that I use to build these analysis, the same institutional approach that I have developed across a decade of training and refined it at Goldman, it's in the free trading program that's linked below. So start there, and I will see you guys on Wednesday.